And Michael, here, as we continue to see some of that sell-off continue, at least in the Dow and the S&P 500, tech-heavy NASDAQ turning into positive territory here, where particularly are you hearing from your own constituents about where they are perhaps charting some opportunities? Again, we continue to hear from some of our guests. It's not timing the market, but it's time in the market. But it seems like it would be a lot of time in the market if you were to get in here.
The two interesting things that I've been hearing from clients in the last few weeks is one on the equity side. Clients continue to ask, is now the time to begin to nibble back in terms of technology and some of those disruptive, innovative companies? As we know, some of them are down 40, 50, 60, 70%. So it's interesting. There is some trepidation, but clients are wondering, is this now a good time to begin adding back to some of those stocks? Interestingly enough, as you said, NASDAQ is kind of flirting with some gains here as yields are falling. And they just showed, Julie just showed the ARC charts there, for example, and a lot of those companies are in the green. The second thing is on the fixed income side. So many clients with bonds so beaten down have started to wonder, is it time to begin to add back to bonds, and some bonds with longer maturities, in the fact that maybe with the economy slowing, some risks elevated, perhaps they should start to kind of inch back into the bond trade, and you'll see some of these losses subside. So I thought those are two somewhat contrarian and interesting observations from clients over the last few weeks.
Well, are they out there, Michael, buying tech?
I'm sorry, Brian, what'd you say? Can you repeat that?
Are they out there buying tech stocks?
I think it's a bit too early. I think what they're doing is starting to wonder if this is the time. So what I've been saying, it's interesting. If you look at the fastest growing companies, the big growers, it's interesting. About 40% of them missed their estimates this quarter. 50% of them make little to no money. So with rising interest rates, that environment continues to be difficult. But what's interesting is that historically, back in July of 2020, these fastest growing companies traded at 7 times the market's multiple in terms of price to sales. Today, it's only 2 to 1, only twice the market multiple. And typically at these valuation levels, 12 months forward, these companies outperform. And so I think investors are beginning to wonder, although a bottom's difficult to pinpoint, maybe they could begin adding some bargains here. So I think they're starting to add some around the margins, but it's certainly somewhat anxious for them, right? They're not in here with tremendous conviction. And a continued rise in interest rates is the biggest risk to that trade in terms of unprofitable companies with a long runway to profitability. Higher rates is going to continue to weigh on those stocks.
What's so interesting to me, Michael, it's Julie here, about what we've been hearing from the companies in this latest crop, whether it's a Walmart or a Cisco in very different businesses, is how they've been caught on the back foot, how they've been somehow surprised by what's been occurring. In the case of Walmart and Target, for that matter, the mix shift and what consumers were buying. In the case of Cisco, the shutdown in China, I guess, just worse repercussions than they had anticipated. What surprises do we have further in store, right? Because they, at the same time that they were surprised, it seems like surprises that they should have seen coming. So, I mean, what does all of that portend for the market and for the economy if these huge companies are not managing this well?
Well, so Julie, I think hindsight's always 20/20. I think a lot of folks, ourselves included, anticipated that product inflation would subside, would moderate this year as supply chains cleared. I think two things, and we all know what those two things are, really has put a damper on that forecast. And that is the Ukraine-Russia conflict and China's continued kind of, not aggression, but their continued conviction around the zero COVID policy. So I think both of those surprised many market observers and companies and have kept supply chains weakened and disrupted and have resulted in continued elevated inflation. So I think that those kind of were surprises this year. Now, to me, I think the interesting thing going forward is now the consensus is inflation's peaked and will moderate. And so to me, I think the market is buying into that narrative. So the risk here is, do investors have that wrong? I think inflation will continue to moderate. You just showed the housing data. It's starting to weaken. Leading economic indicators also came out while we've been chatting. They are showing some cracks. Jobless claims are increasing. And yesterday's Target and Walmart earnings continue to suggest there's kind of the early signs here that the economy is beginning to slow. Both businesses and consumers have been negatively impacted by this inflation. And economic numbers are starting to kind of show some weakness here.